Okay, and welcome back to another episode of the Weekly News. And I'm here with Nick Bendel. G'day, Nick. How you doing?
Going well, Owen. Nice to see you again.
Thank you. And Nick, you're here to read the news, and I'm here to put my 2 cents worth in. What's been happening in the past week for yourself?
Oh, that's a very good question. So many jobs over the past week. If I can think of one that comes to mind, we worked on a big email sequence for a mortgage broker, and that was a lot of fun.
Okay, all right. Well, and of course, your business is.
Well, it's Hunter and Scribe, and we write content for property and finance professionals like mortgage brokers.
Fantastic. And here at Leafield Real Estate, being a property management specialist across the country, yes, we've been busy taking on new managements, a lot in Queensland this month. So Townsville as well as Toowoomba and Ipswich. So that's the flavour of the month this month. But also working on a big announcement of trying to finalise our opening up in the Adelaide market. So stay tuned for that one.
Very exciting.
Yes, but let's get into the news this week. Nick, what have we got?
Well, we've got three interesting stories today, Owen. The first one, renters shifting from houses to units. While renters preferred bigger homes during the pandemic, there's been a marked shift towards smaller properties since the pandemic ended, according to PropTrack data. This can be seen by comparing November 2020 data with January 2024 data. Before, houses rented faster than units. Now, units are renting faster than houses. Before, rental searches were 56% houses, 44% units. Now, it's 46% houses and 54% units. Oh, and you have offices in multiple states, so you're across this. Why are renters now preferring units over houses?
It comes down to the shift back from those COVID years. I can recall we were renting units in Waterloo and Surrey Hills in Sydney in that late 2020, and they were taking 3 months to lease, and the rents had dropped by about 30%. And then about 18 months ago, it all started to shift back. And as people moved back to the city to be able to work, so after having moved out to the burbs and to regional areas, to have that wider space and bigger houses because they didn't have to work in the city, they've now all moved back in great flocks, but also the huge amount of immigration, the huge increase in immigration that we'd had over the last couple of years, that's fueled it even more, with international students and other immigrants coming in, needing to be close to universities, being close to the city, being close to work. So the move back to units was fairly swift and fast and quite dramatic at times in some areas. So yes, that 30% drop with 3 months to get leased quickly turned into lines out the door for as far as you could see, with tens and tens of applications on each property, and an increase of up to 50% in rental incomes on these units. So no, not surprising to see these figures come in.
At a national level, Owen, rents have been going up month after month for about 3.5 years now, which means that it's becoming harder and harder for renters to afford accommodation. So I'm wondering, is that maybe one of the bigger factors why people are now choosing cheaper units over more expensive houses?
Well, it's all relative. It's all relative. It's if you need to live somewhere for work, to be closer for work, then that usually dictates what you can afford and what you can live in. So if you have to live near the city for work, then and you've got a certain budget, then you might not be able to afford a house. So yes, there becomes a lot more pressure on units. But yes, there is cycles. That's not sort of even across the country, and even across all capital cities. There's, if you go out to certain areas within Sydney Metro or even the surrounding regional areas like Central Coast, Newcastle, Hunter, you can see that yes, the rents haven't necessarily increased in the last 12, 18 months. And in some areas, they've even sort of flattened and come off a little bit. There's some parts of Queensland, Greater Brisbane area, where rents were skyrocketing, more than anywhere else in the country. And now it's a little bit harder to find tenants. There's still good demand, but they can afford to be a little bit more fussy now about which property they're going to take. So it doesn't necessarily get leased in the first week. Still good demand, but it's not just in units, and it's not just in houses in all areas. So it comes down to the specific area that you're looking at. But in general, in the capital cities, yes, units have become a lot more, and especially larger capital cities, units have become a lot more popular than houses.
Looking into our crystal ball, so previously a majority of renters were looking for houses. Now a majority of renters are looking for units. I'm wondering, Owen, do these things go in cycles? And if so, will there be a time when it shifts back and a majority of renters are again looking for houses?
Yeah, probably not as dramatic as we saw a few years ago. But yes, it will go in cycles. So, and as governments around the country are trying to push for more regional, or I won't call them regional, but more suburban business districts, where workers don't need to necessarily travel into the CBD. So to be able to work all the time, then it'll take less pressure off those inner city areas. But we'll see more units start popping up in these suburban business districts.
Well, shifting gears from the rental market to the economy, for our second story, Queensland leads the way on wages growth. The average worker got a 4.2% raise during 2023, which was the highest annual wages growth since 2009, according to the latest data from the Australian Bureau of Statistics. So again, annual wages growth 4.2%. Looking at the state-by-state breakdown, Queensland 4.8, WA 4.7, New South Wales, Tasmania and Northern Territory 4.3, South Australia 4%, the ACT 3.9%, and Victoria 3.7%. Interestingly, Owen, wages growth, as we mentioned, was 4.2% last year, and inflation was 4.1%. So wages are once again growing faster than inflation. Do you think this is just a short-term anomaly, or do you expect that trend of wages growing faster than inflation to continue?
I personally, I can't see how it could continue at that growth rate. There was a bit of catching up to do, and certainly to be able to catch up with inflation over the last couple of years. But if it was to continue that quickly, then it would start having more inflationary effects, and then we wouldn't see interest rates coming down. And so, but it's for all those people who are worried about a recession coming. I think this is a good sign that there's not necessarily a recession coming. Otherwise, businesses industries would be laying off loads of workers, which would take off that wages growth, that pressure on wages growth. So yeah.
Well, funny you should mention that, because the Reserve Bank has forecast that wages growth is going to fall from 4.2% last year to 3.7% this year, and then 3.4% in 2025. Do you think that wages growth is going to fall? And if so, why do you think that would happen?
To be honest, probably a little bit above my pay grade, and it's and if the Reserve Bank has got a crystal ball that good, then I certainly don't have that one. And like anything, if anything's had a huge growth, just like inflation, and there'll be these things go in cycles. So I wouldn't expect, if the inflationary figures come down, and there's a reason to drop interest rates, then there wouldn't be a requirement for wages growth to keep happening, to keep increasing. So yeah, I would expect that it would come off a bit.
Well, I guess if wages growth is going to fall, that would suggest a few things are probably going to happen. That probably means inflation will be falling, unemployment will be rising, and therefore workers have less bargaining power. And with inflation falling, maybe less need also to push for higher wage increases. So if the RBA's forecasts are going to come true, I guess we can expect lower inflation and higher unemployment over the next year or so.
Yes, and the other thing to factor in there is that once the tax cuts kick in 1st of July, then there will be less requirement for people to push for higher wages, because they'll have more money in their pocket. But as a result, what happens when wages growth happens? It's people start getting into higher tax brackets, and the whole bracket creep happens. So the government's giving you tax back from previous years of bracket creep, where wages have grown and suddenly people are paying more in tax. And now, as they're giving you this tax back, wages are starting to grow again, and people will start to creep up into these further tax brackets. So the government's just getting their money back sooner rather than later.
Well, we've gone from the rental market to the economy. For our final story, let's move to the sales market.
Cool.
Vendor discounting at 4% in the regions and 3.5% in the capitals. Vendor discounting has declined in regional property markets over the past 6 months, while remaining unchanged in the combined capital cities, according to CoreLogic. During the January quarter, properties sold for a median vendor discount of 4% in the regions, compared to 4.3% 6 months earlier, and 3.5% in the capital cities, the same as 6 months earlier. Now looking at vendor discounting in each of the capital cities. So again, it was 3.5% the average, and in the individual capital cities, it was Perth 2.6%, Brisbane 3%, Canberra 3.4%, Sydney 3.6%, Melbourne and Adelaide 3.8%, Hobart 4.2%, and Darwin 4.8%. Owen, do you have any insight into why vendor discounting is higher in the regions than the capital cities?
Probably similar to the first story we were talking about with rents, why unit rents are increasing. It's the move back to the capital cities, and so the regional areas are finding that there wouldn't be as many people wanting to move to the regions, maybe some needing to sell. So we're probably seeing a higher level of discounting for those people that want to or need to sell out. and there's not as big a not as big a buyer pool as there was, say, 2 to 3 years ago. And because everyone was wanting to move out of the cities and work from home in the country, have that tree change or sea change up the coast. Yeah.
Well, interestingly, even though, as you said, vendor discounting, it's higher in the regions than the capital cities. Over the past 6 months, vendor discounting has fallen in the combined regions, but remained unchanged in the combined capital cities. Do you have any theories as to why vendor discounting has gone down in the regions, but remained level in the capital cities?
Well, I think it's really more of a story of having to look at the cycles happening within those individual capital cities. If you look back 12 months ago, you would have seen Perth was probably a little bit higher, and maybe Sydney and Melbourne was a little bit lower, and Brisbane would have been definitely a little bit lower. So it's maybe just a shift in the overall average is probably the same, but looking at the individual capital city markets, there's been fluctuations between them. So still nothing huge and nothing unexpected. Yeah, you would expect Hobart and Darwin to be at the highest mark, and you'd expect Perth and Brisbane to be the lowest ones. So especially with Perth being the lowest at 2.6%. I'm surprised anyone has to discount in Perth. It's running that hot.
Yeah, that is interesting. Even in an insanely hot market like Perth, there's still vendor discounting that goes on, which I guess shows you that the average vendor, not every vendor, but the average vendor puts a little bit extra on their price when they first list it for sale.
Yeah, of course. I mean, everyone wants to test it a little bit, but it would be interesting to know whether any of those figures are including off-market sales, and how they're capturing that information. Yeah, we work with a lot of buyers agents that are buying across the country, and there's huge volumes of properties being bought in Perth by these buyers agents, off-market and pre-market. So the information isn't even of listing prices aren't even getting out there in the marketplace. So yes, that's it would be interesting to know if they're able to get that information into these figures.
I'm going to guess that the figures don't include off-market stuff because when it's on market, you can track it easily.
Yeah.
When it's off market, you're relying on agents to feed that information through, and I think that's unlikely.
Yes, and it's it's a bit like auction clearance rates, which get used a lot in Sydney and Melbourne to determine how hot or not the market is. It's like there's only certain areas of Sydney, and I would suppose in Melbourne as well that use auctions as a method of selling exclusively. So there's many areas of Sydney, I know for sure, that don't use auction. So it's not always a true indicator.
Interestingly, Owen, in our past podcasts, we've used supply and demand 100 times an episode. Today, the magic word has been cycles. So I think from now on, anytime we say supply and demand or cycles, one of us has to have a drink.
Okay. All right. I got my tea here. Yeah. Ready to go.
Okay. Well, thanks for another great chat, and look forward to more news, more cycles, more supply and demand next week.
Yes. Thank you, Nick. And thank you, everyone, for joining us on the podcast. And you'll be able to get access to the podcast on Apple Podcasts, Spotify, and anywhere else you find your podcasts, as well as YouTube, and certainly on all our socials. Thank you, Nick, for joining us, and we'll see you next week.